Hello everyone to Mystery Intrinsic Stock Analysis number 2. Like the previous video, we will go through the usual analysis without mentioning the name of the company at the beginning, but we will reveal it at the end of this video. Please let me know in the comment section below if you like this idea. And before we start, I want to mention that this video is not financial advice and is for entertainment purposes only. The source of all this data in the analysis report is the annual reports that every publicly traded company issues and files with the Securities and Exchange Commission. I'll put a link at the top right corner of this video showing how to download these reports. The company we have in focus today is a Fortune 500 dividend and diversified technology company with a global presence in the following businesses: safety and industrial, transportation and electronics, healthcare, and consumer. This company is among the leading manufacturers of products for many of the markets it serves. We will start by looking at the prior year's revenue. The company has 4 segments. The safety and industrial segment made up 34% of the 2022 revenue. The transportation and electronics segment made up 26%, healthcare segment made 24%, and the consumer segment made about 16%. I want to take a note here about the healthcare segment that is actually made 24% in the prior year's revenue, because we will talk about this segment in the forecast part of this video. Scrolling down, we can see that 54% of the 2022 revenue is made from the Americas, 29% from Asia Pacific, and 17% from Europe, Middle East, and Africa. Moving on to the revenue and the gross margins, we can see that the revenue is mostly increasing from 2015 to 2022, but it decreased few times within this time period, and in 2022 it decreased by about 3%. The cost of sale and operating expenses are moving with the revenue, which makes the gross margin stable and range from 19 to 24%, which is an acceptable percentage. Scrolling down to the free cash flow, unfortunately, it got a big hit in 2022. It is less than 2021 free cash flow by about 34%. And the free cash flow to the revenue ratio, or in other words, how much of the revenue will be free cash flow, decreased to its lowest amount since 2015, which is 11%. Moving on to check the company's solvency, the debt to asset ratio is decreasing since 2019 and went from 45% of total assets to 34%, which is good news because the Fed keeps increasing the interest rate. This means the companies are facing bigger bills to pay their interest expense. Scrolling down, we can see that the company has no problem servicing the debt because in 2022 the times interest earned ratio is 19. This means that this company made an earning 19 times the interest expense they have to pay. So we don't have to worry about the debt for this company. Next, we will look at the outstanding shares. The company is doing a nice job of gradually reducing their outstanding shares. Since 2015, the company reduced its outstanding shares by about 9.3%. But we have the 2023 Q1 report, and surprisingly, it seems that they issued some stocks this time instead of buying them back. So we need to wait for more reports in the coming quarters to see if that's one-time thing or a reverse of their previous policy. Moving on to the dividends, this company distributed dividends since 2015, and in 2022 they distributed about $6 per share, and using the last dividend and the current stock price, the dividend yield is about 6.48%. Also, the 2023 Q1 report shows a $1.50 dividend distribution per share, so this could be an indication that this company will continue distributing dividends in 2023. Now we can move to the forecast part. As usual, we look for a financial ratio that relates the revenue to another item in the financial statements to forecast the revenue. And after trying different ratios, in my opinion, the asset to the revenue ratio, or the asset turnover ratio, is a very consistent in the prior years that we're examining, so we will be using this ratio in this analysis. The next item that we need in the forecast keys is the free cash flow to the revenue ratio. And if we go back to the first tab of this analysis report, we can see that it's going down for the past few years, with the lowest ratio of 11% being last year. So to be conservative, we will assume it will be only 10% for the next year. For the outstanding shares, we'll be using the number of shares provided in the 2023 Q1 report and assume that the company will not issue or buy more shares. Next is the discount rate. We'll be using the most recent 26 weeks Treasury bill rate. In the top right corner of this video, a link will appear for the video that shows you how to find this rate. Finally, we will start by using the dividend yield as our return on investment ratio. But there is something that we learned about this company from reading the 2022 annual report, which is that this company is facing many lawsuits in regard to two issues. So we have to increase the return on investment ratio to address the risk that's coming from the possibility of losing the lawsuits and paying billions. Moving on to the next tab to forecast 2023 numbers, in my opinion, when using the dividend yield as a return on investment ratio, the intrinsic value of the stock is about $90 and the current stock price is $93, so it's overvalued by about 3.5%. But we are not done, because now we should also address the risk coming from the lawsuits. I think at least we need to consider returning our initial investment in 8 years. So in my opinion, we should be using 12%, which will give us an intrinsic value that's about $48.50 per share, making the stock overvalued by about 92% because the current stock price is $93. At this point, you can't believe my disappointment when I realized the intrinsic value, because I was very excited at the beginning with 6.48% dividend yield. So let's go over what we learned about this company before revealing the name. The revenue is generally increasing year over year, except in 2022 went down by about 3%. The cost of sale and the operating expenses are growing naturally. The free cash flow is going down in the past 2 years. The current debt to asset ratio and servicing the debt are not a concern. The company issued some more stocks in the first quarter of 2023. The dividend yield is about 6.48%. Finally, the company is facing major lawsuits which increase the risk of this investment. The intrinsic value is about $48.50 per share, and the current stock price is $93. Would you invest in this company based on this intrinsic analysis? Please let me know in the comment section. The company name is 3M, with the ticker symbol MMM. If we check the stock price graph, it's down by about 36% in the last year alone, and about 53% in the last 5 years. There is another thing in the annual report that will affect 2024 valuation. So in July of 2022, 3M announced the split of its healthcare segment into a new public company, but will maintain 19.9% ownership of the new company. In other words, 80.1% of this segment's revenue will not be included in 3M revenue starting from 2024, because the split is expected to happen at the end of 2023. The healthcare segment generated 24% of 2022 revenue, as we can see here in the pie chart. So we should consider forecasting 2024 as well. Assuming everything else is the same, such as the outstanding shares, the free cash flow level, the dividend yield, and the lawsuits are not settled yet, which are very hard assumptions to do, in my opinion, 2024 revenue will be around $27.4 billion, and using 12% return on investment ratio, the intrinsic value is about $39 per share. Now, it's your turn to tell me what you think, because I'm very curious to know your opinion about this stock and this analysis. Finally, please consider subscribing to the channel to motivate me to make more videos.